Good evening to all the panelists. Thank you so much for taking time out and joining into this evening's broadcast. A very special guest with me, Mr. Amit Jatia, the Vice Chairman of Westlife Development that runs the chain for McDonald's in West and South of India. A very hard-working entrepreneur who's gone through the grinds of even the Hamburger University in the United States. A very distinguished entrepreneur who's been awarded by many awards, and one of the only two listed pure play quick service restaurant companies in India. Though, of course, Amit, it would have been good speaking with you if you were in Bombay or in India, but good to have you from London as well. Thank you so much for your time today. Good to have you on the show. How have you been?
I'm all right, Rahul. Good to be here. I just got in last week. So, just a nice change actually. And it's lovely to be here, and thank you for inviting me today.
Excellent. So I have my own vested interest, Amit, because it's one of the stocks that we have pitched as our top recommendations for quite some time. So I'd probably want you to lay out, the story as we go along. But before we get into the specifics of Westlife and where McDonald's goes from here in India, I just want to go back a little bit in time and figure out how you got into this business. Just reading the Jatias were into paper, textiles, chemicals, and then burgers happened, I think in the early 90s. Can you just walk us through a little bit about how that happened? How did this association come to be?
Sure. I think sometimes when things are not planned, they go quite well. And as Steve Jobs says, you can never connect the dots looking ahead, but when you look back, the dots connect. And, I was happily running our family's lubricant business. And can you imagine that me running lubricants and then McDonald's saying, wow, he's all right to be involved with the burger business as well. But essentially, the lubricant business was a service business, and it was all about customers, and it was about how you organize even a product like lubricant into a service business. And that's the part they really liked. So coincidentally, our family had just done a reorganization, and the paper mill and the other larger businesses went to our cousins. So at that time, we were looking for opportunities, and out of the blue, I happened to go meet my dear friend at Leo Burnett, and I was telling him, let me put this product on television, some lubricant. And then he said that, forget lubricants, McDonald's is looking for partners in India, and would you be interested? I said, Walter, you must be out of your mind. I'm a vegetarian, and you want me to sell beef and all of that? So this is how it all started. Net, I met McDonald's, and just in a short span of 9 months, I signed the joint venture agreement with them, just like a new baby.
So I'm intrigued, Amit. You're a Marwadi and you got into a business that serves meat. Was it hard convincing your parents? I think you were what, in your mid to late 20s when McDonald's must have given you that call. So how difficult was this to sell to your parents?
I was 27 years old, and yes, in our family, we don't eat non-vegetarian and, not even eggs. I don't even eat eggs. But, some of my other cousins, they are into hotels. And I managed to convince my dad that I'm not eating, the non-vegetarian products. And in our Hindu culture, people do eat. So we are only doing what people are already doing. And if I don't do it, somebody else will. Net, he got convinced. And I'm glad he did. And here we are after many years.
That's awesome. So Amit, let me sort of tie in a question that, I get when I discuss McDonald's with my clients to maybe that call that you got in the early 90s. When McDonald's was coming to India, how did this happen in terms of the bifurcation of West and South versus North and East? Why were you not offered the entire piece of the puzzle? Or why were the people who were running North and East not offered the entire piece of the puzzle?
Sure. So, if you look at McDonald's history in any country, typically they've always started with multiple partners. What happens, there are two reasons for that primarily. First and foremost, two partners can develop the market faster. And, 1 billion people in India, McDonald's, of course, at that time thought it's a 2,000 restaurant market. They had just opened China, and they felt that in India, if you have multiple partners, the speed will be better. The second reason, of course, is hedging their bets. They felt that if they have two partners, maybe one or two of them, who would really work out to be the right partner for us in the long term. So I have seen a lot of consolidation and a lot of breaking up and all of that over my last 25 years with McDonald's. But the rationale was, in fact, at that time, they were even thinking that we'll break up the other markets as well. So maybe under me, but if they would have a licensee, say for South, who would report into HRPL, but would be a licensee for South. The whole idea was speed. So that is really the rationale. And, that is what drove the early results, the early decision making.
But as you scaled up the business over the years, Amit, was there ever a temptation to probably discuss with them to take the entire Pan India license? I mean, how does it work in comparable economies? Aren't they? Don't they have single partners in some countries?
They do. They do. There's a lot of consolidation that has happened. But so in India also it was no different when the event happened in 2013 and 14, right? I mean, there was a possibility of sort of merging the two companies into one. But really, for me, it was all about, firstly, we had 500 million customers.
Mm-hmm.
So growth was never a question or an issue. And finally, as I've always maintained, it had to be the right uh, chemistry and right terms for them and for me. Meanwhile, you see, too much water had flown under the bridge. And, 5 years went by for them trying to resolve the Delhi issue, where we moved up as a brand quite significantly. And then the whole brand in North India really took a beating. And, therefore, finally, we decided that it's better somebody else comes in with new capital and then drives that business just like we did, 20, 25 years ago. So that was the rationale. To me, if suppose my growth is getting stunted, or I'm not able to, see this business as $1 billion, $2 billion in sales, right? I understand my desperation to get that business. But having 500 million customers and some of the top cities in South and West, if you look at Chennai, Hyderabad, Bangalore, Pune, Ahmedabad, Mumbai, they're all absolutely top-notch cities. And each of them have been growing like crazy in urbanization. So I didn't feel the need to go really crazy and stretch myself and the business and put this business at risk as well in order to just acquire that, because that is kind of the sexy thing to do. So we felt that it is prudent, and if prudence is the way to move forward and it works out in a financial structure that is relevant to us, we would do it. Otherwise, we would continue with what we are doing. So now that the jury is out there, we are continuing what we started with.
Uh, I think the next question that I'm going to ask you is very important from the longer conversation standpoint that I'm going to have in terms of product quality and how hands-on you are. I want you to briefly touch upon your stint at the Hamburger University, why you did that, being the promoter of your company, and why you chose to go as being a hands-on promoter when, say, your only other listed competitor in India as on today does employ a professional CEO and you chose not to do it. So a little bit about your stint there and why you have chosen to go this model or this route vis-a-vis your only other listed competitor.
First and foremost, I'm going back 25 years.
Mm-hmm.
And I'll tell you, when I look back, is there anything that I would change? Absolutely not, especially in this area. So the fact that in McDonald's, they insist that every partner and licensee needs to understand the restaurant. Because if you don't understand the operating environment in the restaurant, when you make product decisions, you make equipment decisions, you make employee safety decisions, you have no context to what's really happening in the restaurant. The first thing we did when we signed the joint venture agreement, you'll be surprised that we signed that on 31st March 1995. On April 20th, 1995, 20 of my managers and myself, including my family, we all went into Indonesia. And I started as crew in Indonesia, went through all the exams that a crew would have to pass. And eventually that all culminated at Hamburger University. So Hamburger University is not just one course, it's this whole 9-month program that we go through. And Hamburger University is like you're in a Harvard classroom, and it's all about content. It's not about the restaurant alone when it comes finally down to Hamburger University. I think that the foundation that I got in that particular period, I can never go back to that again. Today, you see, my role has changed, the company's context has changed, and taking 9 months out to go back into the restaurant is almost impossible. So I remember reading the ONT, we have an operations and training manual word to word. That's a part of the training. And today when managers talk to me, even today, I tell them, but that's not what the ONT says. So I feel that obviously over the last 5 years, the game has changed. And my philosophy is, I used to tell everybody that I was a managing director from 1995 until 2010, right? But I said that my job changed every 5 years. So by the end of my period, it was not the same job that I had 15 years ago when I first started out. So the point is that having a strong hands-on understanding of the business is helping me today where my context is not day to day. And without having visiting restaurants, I get the consumer sense. I understand what products need to be put into the market and so on and so forth. So today I'm able to run this business even while sort of sitting in London. That is the first part. The second part is that, my belief was that we had a very challenging 25 years. And a lot of our capital from the family was put into this business. And we believed that this is the one business amongst our other businesses that we really want to focus on. And therefore, my philosophy was that if you've got your money on the line, right, the promoter, at least in the early days, can take the risk calls, yeah, that many times, I'm not saying all the times, but many times professionals would either not want to take the risk or might not be able to take the risk. So I think it worked out really well for me. But trust me, we are a very, very professionally run business. And I'm not sort of involved with every decision. Pretty much all the real estate, the decision-making logic is all pretty set in place. And my leadership team that pretty much has built the business with me is in charge as much as I am. So, that is how we sort of built this up.
That's interesting. Amit, when you look back at the journey of 25 years that you're saying, your first store, I remember Bombay was opened in Bandra on Linking Road in 1996. We always talk about the size of the opportunity. Are you sort of satisfied or, have things gone as per plan as to where we are? I mean, I would have personally thought, given the demographics, that, the size of the business could have been much bigger. Why do you think it is just where it is? And I don't just say this to you. We do track another listed footwear company, which is probably one of the largest in India and organized. And I'm really surprised when I look at their top line as well, because it's almost an essential, and pretty much all of us wore their brands when we went to school as kids. So sometimes it surprises me that the top line is just so much when the opportunity is so large, and we keep wondering whether this is an inflection point. This is an inflection point. So how do you read this?
Sure. So it's a very good question. And obviously, things never went as per business plan. I've learned in whatever startups I've seen, and we were a startup 25 years ago with zero sales, your business plan is completely different from where you started out. So what sales we had expected in the early days, right from day one, was never really where it needed to be, but the number of people was always beyond what we had ever anticipated. So for example, the queues that we saw in Bandra and the number of people that we served on the first day was crazy. But remember, we started with 15 rupee burgers. So finally, the average check being so low, even the large number of people kept the average unit volume quite challenging. Now, I remember in the very early days, because we've been doing research for consumer research right from day one. Even in a city like Mumbai, right? And therefore, I'm taking Mumbai, which is one of our fastest growing cities, pretty rich city as well compared to rest of India. Out of 100 occasions of eating, people were eating out only 3 times as early as 2001, 2002, 2003. And because the frequency of eating out was so low, if I were to compare that even to a Jakarta, right? At that time, Jakarta was 8 to 10 times. Today, from 2003 to 2020, in a city like Mumbai, we are 10 to 12 times frequency of eating out, right? While Jakarta has gone to 20, 25. So my learning has been that the depth in the Indian market is not there in any category that you see. So we keep talking about per capita consumption, we keep talking about all of that, but I think India is still a long way to go. Will India not get there? In my view, it will. But I believe that it's about GDP. Okay, finally, we are linked to GDP. You can't run an industry in isolation. Because we are so consumer centric, I think if you look at our overall growth from zero to, today's 1,550 crores in sales for selling 25 rupee burgers that we do, that's actually quite substantial with 10,000 people in a platform that is unbelievable. Another point I want to make is that the first 10 to 11 years took time to get the model right, supply chain in place. And we built only 20 restaurants, right? But then in the last 3 years, we built over 100 restaurants. So I think the journey is yet another 10 years out. It's getting better by the day. But events like this, like the COVID situation that we are facing, pull us back a little bit. and that averages out. So for example, last 3 years, we've been growing at a compounded rate of about 20%. And we were quite in a positive role. And we thought that we would continue this for another 3 to 4 years. And that is why Vision 2022 talks about 2,500 to 3,000 crores in sales. And we were quite confident of getting there. So in summary, in the 25-year journey, you've got to break it up in parts. The early days was about getting the business model right, supply chain, menu, consumer, and so on, and getting consumers to understand burgers and what it is to eat out. The second phase was to get trial done, to get consumers to come and try the brand. And the third phase was really what I call acceleration. And pretty much that's the phase we are in. So, but just to sum it up, is the acceleration going to be like China? I don't think so, because we don't have the depth in the consumer spending power as yet. But is it faster than ever before? Absolutely it is.
Amit, you touched on store openings. It's not something I wanted to talk about till much later, but since you bought it, I think it's topical to just keep going with it. Is it return on capital employed that drives you the most? And the reason I ask that is, and I go back to your only other listed competitor in India that has about 1,500 stores at their price point. Ours is more a dine-in model. When I look at something like McDonald's, it surprises me that, there are only 25 to 30 store openings when, let me give you an example of BKC in Bandra Kurla complex. And, for people that have joined into this broadcast that are not familiar with BKC, it's one of the larger business districts in Bombay. The connectivity is very poor in BKC. Unless you have your own car, you don't even find an auto rickshaw to take you from one place to another, but you have only one store there. When I talk to people, they say probably 2 or 3 stores of McDonald's could come up in BKC and do very, very well at regular interval. So why is it that you are so cagey about opening stores at a faster pace when some of your competitors are doing so? Is it just an obsession on capital employed? Or do you not think that there is a market beyond a certain number and you want to take your time getting there?
Okay. First thing is you are comparing apples to oranges. Okay. Our average unit volume.
I can't help that. I'm sorry.
No.
I have only apples and oranges to compare. So
no, that's no problem. But I'm just giving context to all the listeners as well.
Sure.
That the two business models are very different, and therefore you cannot compare number of stores. The average unit volume of a McDonald's globally also is about $3 million plus, right? While even globally, if you look at the other listed brand that you're comparing with, they would be around the $800,000-900,000. You understand? So the whole game is very different. We are a full service restaurant. The other big thing for me is that, Rome was not built in a day, and particularly if you don't get real estate right in retail, times like the COVID crisis is really the true test of whether you've got it right or wrong. Remember, 25 years later, we are still standing. And basically, the average unit volume growth that we've got over the last 5 years particularly has been quite phenomenal. And therefore, we don't need 1,500 restaurants to equal the sales of this other listed competitor that you're talking about. Probably at about 500 stores, we could deliver the sales of a 1,500 store of that type, okay, in a typical marketplace. Now, you look at Andheri. In Andheri, we have 2 restaurants right opposite each other, okay, but both those deals are structures that we don't mind doing. While BKC, of course, the average unit volume of that restaurant in BKC is absolutely amazing, and I don't know how it would be compared to the other brands you might talk about, but it's absolutely phenomenal. And for us, getting the quality of real estate right is important. So you will surely see BKC coming up as well. But remember, it took us 20 years to get into BKC to start with, because we don't do things that fundamentally are not right when it comes to real estate. Now, the most important point that we look for is market share. Okay. So in Mumbai, to have 100 restaurants is quite far ahead from any of our real competitors. So who are our real competitors? Our real competitors are people who do burgers. So globally, if you look about it, that business model is closer together. When you extend Western fast food, you get other delivery models, you get pizzas, you get, other types of fast food as well. But if you look at the closest competitors to McDonald's worldwide, our cost structures are similar. Our whole business model is around all day parts, including breakfast, beverages, desserts, etc., etc. So they are a clear comparable. Now, when you look at many of our competitors, and I use Mumbai as an example, where we have a phenomenal market share, our closest competitor would have 25 to 30 restaurants, while we have 100. And in the 100, we make very good money. So obviously, return on capital employed is also material. And McDonald's journey is a marathon. So we are not here for a sprint. And in the short term, if somebody looks like they are ahead, that's okay with us. But what you will see that in blocks of 5 years, the growth that we are able to bring together, right? And remember, we are half the country, so it's not fully comparable, right? We expect that to be better than anybody else in the industry. So let's give it another 5 years and 10 years. You will find that as McDonald's establishes itself, as we get all our day parts out, as we play out our menu, as we continue growing McCafe and other components of our business, and when we are fully fleshed out, you will see us like you see us in Hong Kong, Singapore, Malaysia, Thailand. That's the kind of volume we expect to get over the next 5 years.
So I take your point, Amit. I think, I do acknowledge the fact that your sales per store are nearly twice as much as your nearly listed competitor. And I take that point, and that's well made. But I'm going to regret asking you this question, but I'm just going to ask you from a pure academic perspective, and just throw me a number and then we'll move forward. How many restaurants at full capacity, when you look out, say 5-7 years, do you think McDonald's can have investments on? I'm not asking how many stores you will open. Just saying, what do you think is the size of the market?
I struggle to answer that because you see, for example, let's take a small market. Okay, let's take Nasik or let's take Badlapur or something like that, right? Now, Badlapur, what happens is the key is when we enter Badlapur, we build the model that we make money that we like out of Badlapur. And the real estate deal structure may be 25 years or 30 years. Okay, again, if you look at Bharuch, it's a 35-year deal. Okay, and it's a phenomenal real estate deal. So what happens is you got to introduce the brand, and it takes time for it to build. But we make money pretty much from within 6 months, and we break even and don't lose cash within the first year. Okay, and that market keeps growing. Like if you look at Nasik today, the average unit volume there is comparable and better than the average volume that we have as a company. Having said that, it's not that, out of our current restaurants, we would have 100-150 restaurants that do substantially higher volume than our average unit volume. Okay, and the long-term idea is by the time we get, I've been talking about getting to about 60 million rupees to 65 million rupees as a company, right?
On a per store basis.
On a per store basis, right? Per annum. The point is, by the time we get there, these other stores, we expect them to be at about 80 million. And then when we get that to about 100 million, right, we expect these to flip to 70 million. So my point to you is, we haven't touched the tip of an iceberg. Even in Asia, the average unit volume is $1.3 to $1.5 million, right? Even at their currency level. And we are sitting at 800,000 to 900,000 even in today's situation. So I feel we have a long way to go. And I feel that as the whole system moves up, the stores that are already performing very high will continue to move up as well. But eventually we want to get to at least 70 million to 80 million average unit volume. So I don't know if this answers your question, but I feel it's a moving target. And I feel that we want to get to at least 70 million to 80 million as a company.
No, I don't think you answered my question specifically, but you did help my analyst model in something. I can assure you of that. So I got something out of that answer, for sure. So I want to focus on two different aspects now, Amit. One is real estate and one is products. Let's take real estate first. As you said in one of your earlier answers, this is a serious real estate business, and you are also on the board of Inox Leisure, which is also a very it's basically an out and out real estate place, location. Tell me how you go about identifying a property, how you go about locking in these leases, how do you get it to work in your favor, and then stay over a period of time. How does that move to your advantage?
Sure. So I believe people say that retail is real estate, and I don't completely agree to it, but there is some truth in it. And especially in India, where the business model is very fringe. Yeah, it's not that, every restaurant is making money off the top of your hat like crazy, because obviously sales need to grow. Therefore, if you don't get real estate right, I feel that in the long term, it's game over. Okay. And therefore, we put a lot of energy in getting real estate right. So the first thing is you need a portfolio. Okay. So what I mean by portfolio, and it's like any analyst who would not just stick to one stock, but would diversify the number of stock so that it's a hedge against good times and bad times. So we like presence in malls, we like drive-throughs, we like transit points, we like high street. And actually in COVID times, it's playing out quite well. Imagine if we were only in malls, and a lot of malls are not operational today because of government restrictions. Our business would be at zero. But today we are able to cover the entire city of Mumbai with only 30 restaurants, which are all high street oriented. And we are not really dependent on malls alone. The other thing is drive-through brings a whole different element. And I want to go back to your previous opening comment where you said that McDonald's is more an in-store business. I don't think people in India yet understand McDonald's. It's not an in-store business alone. I can't quote numbers from the global business, but over 50% of our sales is not in store, even globally. And even in India, about 45 to 50% is not in store. So in India, we are not even at the global number. Now, coming back to real estate, the first thing is diversified portfolio. I think you got a sense of that. The second thing is risk management. So, for example, in all our malls today, while there are a bunch of 200 retailers who've sort of come together to talk to malls about getting revenue share deals, we are not part of that group because we already have only revenue share deals in malls. Okay, so we don't give minimum guarantees in malls because if you're sitting on the third floor of a food court, a lot depends on what the mall brings in terms of footfalls. And we know as brand McDonald's that once the footfall is in, we know how to capture it. So we have taken a tougher stand, but we've insisted on revenue share. And malls are happy because in a food court, we do substantial business. So the second is risk management. So for example, if we open a restaurant in Bharuch, we'll take a long tenure because we payback sometimes are longer. If you do drive-thrus, you want straight percentage of sale deal sometimes, and so on and so forth. So that is the second big aspect. The third is because paybacks are 3 to 4 years, right? By the time we start making money, we don't want to see that our term is over. So therefore, we try to do a minimum of 20-year deals, okay, with rent increases every 5 years. Again, these are significant advantages because what happens in a year like COVID, you lose this year. Now, imagine if you had rental increases every 3 years, the compounding is just crazy. Versus if you look at the HRPL lease structure, in a 10-year cycle, the rent has gone up once in the 6th year. Okay, so that gives us fundamental advantages in building sales, while keeping rent quite constant. So to my mind, the last bit is location. Okay, it is the most important thing. So what we have done in McDonald's, we understand a location and we understand why a restaurant works and why a restaurant fails. So there is something called trading area surveys, and we have done that for 250 restaurants. And when you do a trading area survey, you start understanding what do you look for in a site when you build. So the crux in getting real estate right is to being able to predict sales by 90% accuracy. If you are able to predict sales 90% accuracy, you won the game. Because imagine, take Andheri East, okay? When you have one restaurant in Andheri East, it's no problem. But if you want to build 8 restaurants in Andheri East, you need to know where consumers are going, what's the closest diameter from where customers are coming, where are customers not coming from, where should the next restaurant be put. Because if you put it wrong, you will either impact this restaurant or you will put it in the middle where you will impact another restaurant that you could have built. So I hope you understand that real estate is extremely key in getting this right. And we believe we have that. So I hope this gives you a bit of an idea.
No, it does, and I think it's extremely important to understand that. And we face that a lot when we are even pitching our stocks in the multiplex sector, for example, and maybe even in retail. When we look at footwear companies and so on and so forth. But you mentioned something interesting, which I don't think maybe the non-institutional viewers on this broadcast probably are maybe hearing this for the first time. You said almost about 40 to 45% of your business is non-dining. So that would be a mixture of delivery plus takeout plus drive-thrus and all of that.
Correct.
Right. Now, just want to go to the product side of the business, Amit. Breakfast was started in 2010, if I'm not mistaken. there
Yeah.
or thereabouts.
Around.
And McFlurry was also started in the early part of the last decade, somewhere around 2011, 2012. Uh, why hasn't breakfast scaled up in the way you probably envisaged it to by now? And what took so long for McCafe to become what it is today? Could these not bigger push a little earlier in the cycle?
See, that's my point. I was explaining that recently to somebody that you have to build a brand brick by
Mm-hmm.
brick. So, for example, when we started in 1996, we had chicken nuggets on the menu, we had McFlurry on the menu, McCafe was out, and all that. But customers didn't know McDonald's to start with. Okay, customers had to experience burgers, and we were learning a lot about their preferences, about how they use McDonald's. We had to teach them what self-service is. We had to teach them what it is to, after you finish your meal, you take the tray and you have to sort of, help yourself and clear the trays out. So there was a lot of learning, and we wanted to start it with what we called a core menu. We always knew that you need a certain platform, like say 100 stores or 200 stores, before you launch something like say a McFlurry. Okay, so now consumers have some sense of what brand McDonald's is. There's a dessert offering this, but the hero of the dessert, we launched actually in 2007, 2008 with a big TV campaign, and suddenly
Mm-hmm.
McFlurry became a hit, and it revitalized the brand. Okay, so similarly, there's a time for everything. Now, when people understood McDonald's completely, that was the time to bring coffee. Now, also remember, Cafe Coffee Day was doing the hard work of training people on what it is to have a barista made coffee and to pay higher prices for coffee as well. I always joke internally that if we would have started with McCafe, we would have priced it so tight that we would have never really made too much money. But thankfully, our competition started McCafe type products, and they priced it so high that they gave us tremendous room, even at 99 rupees, to make a great margin while giving
Mm-hmm.
100% Arabica beans. Because we wanted a certain number of stores available, and that is how you take the brand from one level to the other. And actually, I'll use McCafe as an example that in 2013, to be honest, it was the perfect time. The brand had sort of been left behind by the consumer because we did not keep the pace of change as quick as the consumer. And
Mm-hmm.
essentially, that is why in 2013, when there was a downturn, the GDP dropped, the entire sector took a beating, but we took a beating along with that, and we don't like that. Okay, as leaders in the industry, we believe that we yet need to maintain positive same store sales. So what we corrected at that time was getting the re-imaging going so that the brand became contemporary. And McCafe was a perfect connect with the millennial consumers as well as the office goers and a whole different set of consumers.
Mm-hmm.
And what it did in 2013, 14, 15, it completely revitalized the brand. And what we learned out of that is that, particularly in retail, and this is my big conversation with everybody, is that in retail, you got to evolve every day. And people keep asking me, what's that one big thing that you're going to do tomorrow? And I tell them that the day I have to do one big thing, you should sell my stock. But if every day we are doing a lot of things that you don't find very exciting, yeah, but you can see the brand is changing completely, yeah,
Mm-hmm.
then we are doing our job. And that is how, before McCafe could be completed, we started the experience of the future journey.
Mm-hmm.
Okay, so I hope you're getting a sense that even the menu. If you look at the global menu, is very vast, but in India, brick by brick, we are building that. Most recently, in Southeast Asia, we do really well with fried chicken. And most recently, that was our biggest launch, which got messed up due to COVID. But in April, we launched our Ghost Chili Spicy Chicken, where the consumers were rating it at 9.5 out of 10 to 10.10 out of 10. The product was amazing, and it's a pretty large market. And we felt that now the time has come for McDonald's to move towards chicken leadership as well. So, it's a brick by brick building. We keep listening to the consumers. We keep trying to understand what stage the brand is at. And therefore, what should we take out from the global arsenal and put it out to the consumer today? So I hope, that's really how we think about it. But remember that I feel people are too confused about this dine in and dine out.
Mm-hmm.
Finally, it's the brand. Finally, if you like the food at any restaurant, right, whatever is the consumer change that's happening, that brand's going to accommodate and adjust itself to that.
Mm-hmm.
So I'll cover that more later when I'm sure you'll ask me about delivery.
You've pushed me enough to try and place an order tonight, for sure mentioning those dishes. I've been eating home food for about 3 months now. But tell me, how big can McCafe become? I mean, your product is really quite commendable. I think it's probably one of the best that there is that I've tried. We do track another coffee company which is based out of Hyderabad that has some very good freeze-dried coffee. But yours is right up there. On the bill size, it's obviously made a huge impact. And I'm not trying to say that this is going to be the driver of your growth, but it's a fantastic brand extension. How big could this become? Because I mean, I'm sure as a promoter, the gross margins must be much substantially higher than the rest of the pack, and you want to make this as much as you can. No pun intended.
So I feel our biggest advantage has been that India is under leveraged as a country around beverages, and that was a huge opportunity for McCafe. Okay, to start with, and I think we got the product right, and I think we expanded pretty rapidly. Okay, so we did the barista training right, we got the pricing. So this is one thing that we surely got right. So I feel that the way we think about it is as follows. Let's say the beverage market of these type of products is say a $2 billion or a $3 billion market in India. Yeah, so our view is that why should we not have 10 to 20% share of that particular size? And therefore, if we have 500 restaurants, we expect McCafe to be in every single 500 restaurants. So today we are already at 220 plus, and as we keep opening restaurants, McCafe will be in every single McDonald's. And the idea is for McDonald's to be within a 10-minute reach of the 500 million customers that are there in our territory. And therefore, we want McCafe to be in the reach of these 500 million consumers as well. So I feel that in India, we have this unique opportunity because they are the problem is, and that's an advantage to us, is that because beverage consumption also is very limited, as I've said before, that per capita of everything in India is low, it makes standalone beverage models very challenging. Okay, so therefore our store-in-store concept, where there's a core McDonald's that the investment has already been made for, and you spend incrementally, and the same management team, same infrastructure, delivery, backbone, all that is servicing this McCafe, the cost structure becomes a significant advantage for us. Obviously, you always, in everything, when you gain something, you lose something, and when you lose something, you gain something. So what we do lose is that coffee environment that one could get in some other competitors. But during certain day parts, we get that as well. Because we are a lunch and dinner business, so in other day parts, we can provide that atmosphere as well. But I feel overall we gain far more. So I see McCafe to keep pace with our restaurant opening. So if we are going to be 500 restaurants or 1,000 one day, there will be 500 to 1,000 McCafes as well. The beverage market is 2 to 3 billion is my estimate, internally based on our research. We think 10 to 20% is what we feel we should get. McCafe has been growing amazingly well, and every 2 years in our Investor Day, we give some sense on that. So I feel that not only the 200 will become 320, which is our current restaurant base, but if average unit volume per McCafe is 100 rupees, it will become 200 as well. So I think McCafe is going to continue to substantially grow as a part of our plan.
So when you say the size of the beverage market is 2 billion, you're including coffee plus maybe the milkshakes and the McFlurries and all all that. And you want
not
to be
not McFlurry, but yes, all the beverages that are sold out of McCafe, it includes aerated out of restaurants. So our estimate is out of home consumption of beverages.
And you want to capture about 10 to 20% of that market is what you're saying.
That's the vision, that's the thought, dream.
Fair enough. Now, I don't know whether you'll get into specifics of McCafe sales and investments, but can you just help me understand what is the ROI you generate on McCafe?
See, it is substantial because, the full service restaurant is already in place, and that's how we see it. So, the chiller, freezer, management team, everything is there. So incrementally, I can tell you, it just costs us about 2 million, 2.5 million rupees to build a McCafe. Okay. And because of the margin structure, our returns are absolutely phenomenal, because already our sales to investment ratio for McCafe is substantially higher than our overall sales to investment. So if you look at our gross block to sales, we have 1.5 times or so, which has improved from 1:1 to 1.5 over the last 3 to 4 years. The idea is to take that to about 2 times. So which is why the big focus on average unit volume. And McCafe is obviously even double of that.
Right.
So we are in good shape with that.
So now, if I look at your financials, Amit, over the last, say, 5 or 6 years, you've grown your gross margin, your what you call the restaurant operating margin, as well as your core operating profit margin. Each of these have grown by give or take about 800 basis points in the last maybe 5 or 6 years. That's a little more than 100 basis points each year before we hit this speed breaker. Would you say that the acceleration over the last 2-3 years in that has come because of brand extension, or is it more back end in terms of supply chain sourcing, because your gross margins have expanded and because you have a very strong network with your supply chain? Some of it may be exclusive. Can you help us understand how that journey has sort of, how you have traversed it, and what do you think is the trajectory from here on? Because I understand you put out a Vision 2020 that may or may not hit its target because of COVID, but sort of what has gone in that journey of the expansion, and sort of how do you see
Sure.
it panning out from here?
Actually, there's no one thing that I feel is the driver, but a number of things. And basically, I call it the reinvention of brand McDonald's in India, where the journey started in 2013. Pre 2013, we were a value play, and people were coming to us largely for the happy price menu and the convenience of McDonald's being around. From 2013, we decided that whether there's a downturn or an upturn, okay, leaving a COVID type situation where it's unprecedented, yeah, we have to grow our same store sales up. And we've got to keep pace with the consumer changes, and we have to stay ahead of the curve. So what has changed for McDonald's, which is why, all of these things have worked, is that we've changed the consumer perception around McDonald's by re-imaging and making the stores modern and contemporary. I think McCafe has added an element, delivery has added an element to it. The big changes we've made to the menu have added an element to it. So I call it the 1 + 1 + 1 is equal to 5. And
Right.
now the wheel is churning. Okay, so McCafe wouldn't do well if there was no delivery, because the breakfast business is being built around delivery as well, right? But McCafe is helping the breakfast business because people come in the morning to have a cup of coffee. When they come and have a McCafe, they want to buy a French fry. Okay, and the changes we've made in the menu with a bit more premiumization with the Maharaja Mac, both for veg and non-veg, some of the other work and other products we've done, and a lot of focus around health as well. So today there's a wheat bun option at McDonald's. There are no preservatives in our patties. So we made significant formulation changes as we've gone along. And we've talked about all of that. So I would say we are a different brand. And it's all a combination of these few things that I talked about that has given the consumer a different perception of brand McDonald's. So I remember in 2013, I would tell my people, let's say we put something up on social media. There would be a lot of negative comments around McDonald's. The brand had taken a beating. Then I started noticing in 18, 19, 20, if you see particularly EOTF stores and you see Google reviews from consumers, and I'm talking 1,000 consumers, yeah, the ratings would be 4.3, 4.4. And that clearly told me that from a 3.3 to 4.4, and I'm talking about not our research, this is Google, yeah, clearly the brand had changed. And the positive comment that started coming in were phenomenal. So it's a combination of all of these things, Rahul.
Will you be able to share how much of your revenues, incremental, have come in from, say, the launches you have done in the last 3 years?
We don't share that breakup at all.
You don't.
But I just want to remind you that, see, what happens many times when the brand gets left behind and the consumer has to move forward is that even take for example, an aloo tikki lover, yeah, would not come into McDonald's because they had lost connection with the brand. Okay. So the minute we were able to reconnect that consumer with McDonald's, whether it's to do with McCafe or whatever, even aloo tikki starts selling a bit more. Okay, because there's a whole generation that grew up on, say, an aloo tikki, McVeggie, McChicken, and McFilet-O-Fish, for example. So I don't think, Rahul, it's one or two things, but I do believe that if we wouldn't have done those one or two things, it would not have helped bring what I call lapsed users back into the fold, which is what has helped us grow the overall business.
I'm not sure how I want to frame the next question, but how many brands or how many products do you have that give you more than 100 crores in sales? So, you mentioned certain iconic products like the Maharaja Mac, the Aloo Tikki, the McChicken. How many of these actually give you, say, north of 50 crores or north of 100 crores of business? We ask this to FMCG companies all the time. Consumer
We
staple
don't
companies.
share that breakup, but in our investor presentation, I had indicated once that we have many products that stay beyond the 100 crore, that give us sales beyond 100 crores. And recently I've not looked at it. I'm sure McCafe would be part of that list as well, probably cappuccino. But we, thankfully, we have brands. See, today, when people talk to me about other burger competitors, so I always tell them that one, it's good that there are more burger companies because then burgers start becoming ubiquitous for the consumer. But when the consumer thinks of a burger, if the sub-brand like Aloo Tikki, McChicken, McVeggie, Maharaja Max starts resonating with the consumer, then we've done our job. So we fortunately have many such brands, including the Piri Piri, by the way. You know, the French fry Piri Piri has become a cult following. And we get demand, like people will call up and say, we want 100 of those sachets for delivery. So, you know, we have cult brand followings on number of fronts.
I want to throw another brand extension at you. People are getting into biryani. You know, your other listed competitor has gone into Chinese. You yourself have tried the rice bowl. How big is this brand extension market? I mean, what does it look like for the QSR industry and for McDonald's also? I mean, where all would you look to branch out going forward?
So rice is not new to McDonald's. Globally, we do rice in most of the Southeast Asian markets. And therefore, in India, we decided we will do rice as well. It's an important offering that goes with a number of our products as a side. Okay. So what happens is, while we are still a burger company per se, and we have wraps as well, but we believe that there are service products where a family comes in. You know, there may be people who may not want burgers, but may want a wrap. There'll be other people who may want, you know, something else. And that's why we need to have an offering that's complete. So I think the rice market is pretty large. Our philosophy is that we would do things in a brand McDonald's sort of connect. So whether it's a biryani, I doubt that, but we will continue to evolve rice in our own way. In fact, along with the fried chicken that we did in Chennai, we had reinvented rice further based on consumer feedback, and that was to be launched, and it will be pretty soon. But the consumer feedback we got in tests around this slightly further evolved version of the rice was phenomenal. So you will see rice as a part of it, but we believe in staying with the core. So, you know, for example, we have a very good sense of what is core and what fits in with McDonald's brand. And therefore, we are not going to extend from that. But for example, we had done a Szechuan burger. We just done one recently. But many years ago, about 10, 15 years ago, we had a Chinese burger. The Chinese food had a significant appeal, at least in those days.
I don't think you can mention that right now.
Yeah, I know. That's what I'm saying. So we don't have that anymore. But I'm just saying that we stick to things within core McDonald's, and we are able to bring a dosa masala burger, but not a dosa, and that is our specialty.
That sounds very interesting, Amit. Tell me, this last 3 months, what has it taught you from a business standpoint? What's changed? How is business likely to be when we reopen at full tilt? As a company, what changes, what lessons have you imbibed? Both from an internal training perspective, customer perspective, how you intend to grow the brand?
So first thing it has taught me is that it reconfirmed my thinking that a business is never built for only great times. And I akin my company as a ship that is making a journey going from, say, you know, India to Sao Paulo. So it's a long journey. Okay. And along the way, there will be turbulence. And if you've taken away all the resources of the ship during great times and gone so fast, right, then you may just run out of fuel in the middle of the ocean. And I call them oxygen canisters. And therefore, you know, we believe that's why the real estate structure has to be right. And it's not about crazy growth, because I've tracked and learned from competitors as well. Everybody does great things. It's not that we are the only ones that do great things. But we want to do more great things than others, and we want to do less mistakes than others. And therefore, we have to learn from the great things and mistakes of others as well. So I think the biggest learning that has come to me is that it is true that turbulence comes, and something what you can never imagine in your life has happened. And thankfully, our real estate deal structures are pretty good. We had cash on the balance sheet. We had almost zero debt when we entered this crisis. So that is one part of it. The second big part is, of course, I do believe that all these things are short term. I'm a contrarian. Short term doesn't mean that it is 3 months, 6 months. It may be a year, it may be 18 months. But as human beings, we are going to go back to normal the day your mental state changes. Okay, I strongly believe that lockdown makes us more in panic mode and caution mode. And I feel that you've got to start getting back into the real world. Okay, but the right way to get into the real world is by creating the hygiene, health, whatever, masks, etc., etc. So I feel that there is a time right now. What changes are happening, I'll tell you, which I believe some are going to be long term and some are short term. So what is long term in our industry, particularly structurally, brands with high trust scores on health and hygiene are going to be winners. And unfortunately, roadside vendors will take a beating, at least for the next 2 years. Okay, so it may be a structural change where the frequency of use of Western fast food might go up. Okay, the second big thing is that consumers, I feel that the minute the new normal sets in, there will be a rush in the early days. And the rush will start with delivery takeaway, even more than what it is today. And slowly they'll get the confidence back to do in-store. Okay, I don't think the model has changed where in-store has gone to zero. That's a whole separate conversation, but that's my summary. The third thing is that any brand that now can deal with health hygiene in a significant manner and get that perception are going to gain more market share than other people. Okay, and visible cues are extremely important. Okay, whether they in reality change anything, I don't know, but the visible cues to the consumer are very important. So I feel that from brand McDonald's point of view, if somebody is going to survive in the QSR industry, we definitely think we are one of them. The other big thing for me is always long term. So I believe that you tackle the short term, and I always believe all times are good times. You need bad times, you need good times. Both have value, because in good times things cool off. Crazy money is not chasing, valuations don't go mad. People are not willing to pay any amount of crazy rent, because it's not necessary that your competitor is rational. Yeah, but if they are irrational, the customer doesn't care, right? So I will take the brunt of them being irrational as well. So what bad times do is bring rationality across the board. Okay, and that's a good thing, and it gives time for people to recover and do the right things. So I'm a long-term guy, and my philosophy and what we are telling our internally to our leadership team is that we've entered this whole crisis in an X manner. We have to come out with this stronger than X. And if we've achieved that, then we've really utilized this to our advantage.
I take your point very well, Amit, and I think this entire issue of market share that you were saying, it's when we used to push the stock, one of the pushbacks we used to get was that street food is a competition. I can't for the life of me seeing that happening in the short term at least. So I think to that extent, you guys will be beneficiaries. But those were a lot of financial terms you threw from my business: short term, contrarian, long term. But Amit, we were talking about brand extension. Let's talk about your extension, and let's talk about Smita's role in the business. I think you got married very young. You've got 2 young boys. I think one of them is already involved in the business. So let's just talk to us a little bit about her role, her vision for McDonald's, what your son is doing, and what their thoughts are. It will be interesting to know that.
Sure. So, Smita joined the business in 1997. So she's been around for a while. And along the way, including doing a Harvard stint, she kept picking up different departments. She started with marketing. In McDonald's, the crux is operations, marketing. There are these two, and supply chain. These are 3 critical elements in McDonald's. And she started with marketing. She took on operations. She took on training. Then she took finance, strategy. And in 2010, she became the managing director of the company. Then, my philosophy has always been that as I saw her take on more and more, right, I kept giving on more and more onto her plate. And today, pretty much every day-to-day aspect of the business, including strategic planning, financial planning, everything is done by Smita. My bigger role now has changed dramatically. It's about capital allocation. So finally, if a call has to be made, that, okay, let's grow McCafe, or, okay, what are the number of stores that we need to open? Particularly again, real estate decisions of where to grow, when to grow. While she does play a significant role there as well, but I take sort of a more larger interest and a final call around that. My philosophy is young blood has to drive this business, and that transition has happened. So about 2 to 3 years ago, I asked my leadership team that who are the next 10 people that will be running this company 8 or 5 years or 10 years from now. And then we got Corn Ferry in to help us with the program, and we are well on that journey. So already we are seeing a new bunch of people running and taking charge of this business. And I've been super impressed with their energy. And about 18 to 24 months ago, this new team has started coming into play. And the way they have responded, starting from April of 2019, when India went through a really rough patch, you saw our results from the second quarter onwards last year, right? I mean, April, May, June was slightly a tough quarter, but we responded and changed the strategy in May. And we decided that we are not going to let this downturn impact our results. And it was this team, led by Smita and people there, who really responded very quickly and made those adjustments to give us the best ever profit and the best ever quarter in December. So this is my view. Akshay has joined the business in 2014. He went through a 9-month to 1-year program in the restaurants, just like I had done in Indonesia. Then he became a restaurant manager. Then he was moved into, and he started the delivery journey in 2014. Then he started adding brand extensions. He reports into our sort of COO, who reports into Smita. And more recently, they've expanded his role to digital, and he took on IT recently. So anything that needs fixing, we wanted him to be sort of put straight into the rough waters so that he learns to swim while we are there. And he, along with the leadership team today, they are sort of taking charge, and they are the next lot of leadership team that is going to run this business while I have my oversight. So this is how it is. Smita is completely in charge of the business today.
Interesting. It's been fascinating chatting, Amit. I could go on. I know I've taken up an hour of your time, but I think it's been a very engrossing conversation. I really thank you for this time, for detailing the entire thought process you have behind the company, how you got here, what your vision is going forward as well. And I think I personally have benefited about, we do talk a lot, but there are certain aspects of the business you learn each time that I speak to you. It's been a pleasure interacting, Amit. I hope you had fun being on.
Absolutely, I enjoyed it. It was nice free flowing. And thank you, Rahul, for making it a bit interesting even for me.
Pleasure is entirely mine. Keep safe. Hopefully, we'll see you soon in things normalize. Thank you so much.
Thank you. Everybody.
Much appreciated. Thanks a lot. Take care.